If you're the kind of person who genuinely enjoys time alone, who recharges in silence, thinks better without interruption, and has never quite understood why everyone else needs constant company, you've probably been told, at some point, that this is a flaw. You haven't, because some of the most quietly powerful investors in history shared exactly that preference. And the reason isn't coincidence. By the end of this, you'll understand exactly why solitude and long-term investing success are connected, and which of these 5 traits you may already have without realizing it. There's a strange assumption baked into how most people think about success in investing, that it requires confidence, charisma, a loud voice in a crowded room, that the best investors are always connected, always listening, always reacting, always plugged in. The research points in the opposite direction. Studies on investor behavior consistently show that the investors who trade less, follow the crowd less, and talk about their portfolios less tend to perform better over time, significantly better. Warren Buffett reads for 6 hours a day, in a room, alone. Charlie Munger is famous for saying he has nothing useful to add to most conversations. Howard Marks writes long investor memos as a way of thinking through ideas, not performing for an audience. There's a pattern here, and it runs deeper than strategy or stock picks. We're going to go through 5 traits that people who prefer solitude tend to carry, and exactly how each one translates into an investing edge that almost no one talks about. Let's start with something that might surprise you. Trait 1. They can sit with discomfort without reacting to it. People who are comfortable alone have spent years learning not to fill every quiet moment with action. In investing, that skill is worth more than almost any financial model. Behavioral economists call it action bias. It's the deeply human need to do something during periods of uncertainty, to trade, to rebalance, to check, to respond, even when doing nothing is the statistically superior choice. Studies by Dalbar, a financial research firm, show that the average investor dramatically underperforms the market not because they picked the wrong stocks, but because they bought and sold at the wrong times. They reacted, and every unnecessary reaction has a cost. If you've spent your whole life being comfortable in stillness, if you've sat with silence while others rush to fill it, you may be carrying a natural defense against the single most expensive mistake in investing. You already know how to wait. Most investors are still learning, but sitting with discomfort is just the surface of what solitude teaches. Trait 2. They form their own opinions independently, and they're not easily moved off them. People who enjoy being alone tend to develop a strong internal compass. They're used to reaching their own conclusions without a room full of people to validate them first. In markets, this is called thinking from first principles, and it's genuinely rare. The reason most investors struggle to outperform over time is not a lack of information. It's that everyone has the same information and reaches the same conclusions at the same time. True investment insight almost always comes from thinking differently than the crowd, and thinking differently requires being genuinely comfortable disagreeing with the crowd. That is an emotional skill, not a technical one. Research from finance professor Terence Odean shows that investors who trade based on social signals, tips, media headlines, peer recommendations, consistently underperform those who rely on their own analysis. If your default is to think things through yourself before asking for opinions, if you're instinctively skeptical of consensus before you've checked the logic yourself, that instinct may be more valuable in a portfolio than any stock screener. Now here's where it gets a little more layered. Trait 3. They have an unusually long relationship with patience. Most investors understand, in theory, that patience is important. People who prefer solitude don't just understand it, they've lived it their entire lives. And time in the market is one of the most well-documented edges in investing. $1 invested in the S&P 500 in 1990 and left untouched would be worth roughly 22 times that amount today. But almost no one leaves it untouched. The average holding period for a stock on the New York Stock Exchange has dropped from 8 years in the 1960s to less than 6 months today. The reason isn't strategy, it's anxiety. The inability to sit and wait while the numbers move and the headlines scream. Patience isn't just a virtue in investing, it's a compounding mechanism. Every year you don't sell a winning position unnecessarily is a year the tax man doesn't get involved and the gains keep building. The nuance here is real. Patience without a plan isn't patience. It's passivity. But if you pair the natural stillness of a solitude-oriented personality with a clear investment thesis, you have something that is genuinely hard to teach. And this next trait, most investors never develop it at all. If you're the kind of person who thinks carefully about how your own psychology affects your financial decisions, and clearly you are, or you wouldn't still be watching, it would mean a lot if you subscribed. We put out videos like this every week. Real research, explained in plain language for people who take their financial future seriously. Trait 4, they naturally filter out noise. And in markets, noise is the enemy. People who enjoy solitude tend to be selective about what they let into their mental space. That selectivity, when applied to financial information, is a genuine advantage. The financial media ecosystem, cable news, social media, forums, YouTube, is optimized for engagement, not accuracy. It rewards urgency, conflict, and prediction. The problem is that constant exposure to that environment creates a cognitive illusion that you need to be constantly reacting to new information to be a good investor. You don't. In fact, researchers at the University of California found that investors who checked their portfolios daily made significantly more trades and significantly less money than those who checked monthly or quarterly. The information wasn't helping them. It was hurting them. Not because the information was wrong, but because it triggered action when inaction was the right call. If you've always been selective about the noise you let into your life, if you've preferred depth over volume, you may already be practicing something that professional money managers spend years trying to impose on themselves as discipline. But this last trait goes deeper than strategy. Trait 5, they know themselves, and they build systems around that self-knowledge. The most dangerous investor in the world isn't an uninformed one. It's an overconfident one who doesn't know their own blind spots. People who spend significant time alone tend to develop something psychologists call interoceptive awareness, a deeper than average ability to notice their own internal states, what they're feeling, what's actually driving a decision, whether a judgment is coming from logic or from fear. In investing, this self-awareness has direct financial value. It's what allows someone to notice they're about to make a panic decision and pause. To notice that they're chasing a stock not because of the fundamentals, but because everyone around them seems excited about it. Charlie Munger built an entire framework, his famous mental models approach, around the idea that understanding how your own mind misfires is the single most important edge an investor can develop. It's not about knowing more than everyone else. It's about being honest about what you don't know and what your own psychology is doing to your decisions, quietly, without your permission. If you're someone who has spent years observing yourself, your reactions, your patterns, your instincts, you are already doing the work that most investors skip entirely. You've been building the most valuable investment tool there is, and you didn't even know it was an asset. So here's what this all comes down to. The traits that make someone prefer solitude, comfort with stillness, independent thinking, patience, noise filtering, and deep self-knowledge are not personality quirks to be fixed or outgrown. They are, it turns out, almost exactly the psychological profile of a great long-term investor. The market doesn't reward the loudest voice in the room. It rewards the person who can sit quietly, think clearly, and act deliberately, while everyone else reacts to whatever happened this week. You were probably told at some point that preferring your own company was a disadvantage. In most rooms, maybe it is. But in the market, it's the edge that the loudest people in the room spend their whole careers wishing they had. If you want to go deeper on investor psychology, specifically the cognitive biases that cost ordinary investors the most money every single year, I put together a video on exactly that topic that I think you'll find just as eye-opening. It's right here when you're ready.